we're talking about how to invest smarter in 2023. Just want to say a big shout out to our event partner, Perla. If you're not already around what these guys are doing, you should check them out because they're up to some pretty cool stuff and ties in pretty nicely with what we'll be talking about today on how to invest and how to invest smarter as well. Guys, if you like this content, you can check out our other channels, upcoming events, socials, podcasts, how to be successful with money. And there's a ton of events that we've got scheduled between now and into the new year. So you can check them out on the Eventbrite. And in fact, I might actually just pop that into the chat in a sec as well. Now in the chat. So guys, look, please don't rush out and make any life-changing decisions off what we cover today. I strongly suggest you seek out personalized advice from someone with a glorious beard before jumping in. If you're making big investment decisions, you probably should be doing that anyway. So firstly, I just want to say well done. Well done on being here, taking the time to register for this session and to jump on live. I think money success is all about having good habits. If you look at people that are really successful with their money, like people that are really successful in any area of life, they make it look really easy. But what you don't see is the decades of practice and habit building that they've used to put them into that position. I find that this time of year, the new year brings a lot of people starting to think about, the things that they want to be doing better, get that six pack, get a bit better with their money, get on top of investing, buy that property or whatever. You got to capitalize on that motivation, because I've been helping people with their money for a bit over a decade. And I've noticed that every New Year's, I start talking to a lot of people that all pumped up to do better. And I've noticed that not all of them make it there. Like not everyone gets a six pack. The people that do the best are the people that put habits in place or put structures in place to push them forward to keep that momentum building. So you got to capitalize on the momentum. So shout out for joining here. Easy enough to switch off and think you're going to catch up on the replay, but never actually do that. Money is one of these things that it is really important, but it's never really urgent. So it's really easy to put it off on the back burner for some tomorrow that never comes around. And I hope that each and every single one of you guys today get some really interesting, great ideas and things that you can do to do better with your money. But please, 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 you should know that the key to getting results, to actually getting the outcomes from this session, is about taking action. You've got to do some stuff. You've got to get started investing. You've got to increase that investment contribution. You've got to save a little bit more. You've got to pay down that debt, or whatever the case may be. So what we're going to do today, I'm going to take you through the things that you need to know on how to invest smarter. But at the end, I'm going to show you how you can take action and what your next steps are, so that you can put some things in place to start building that momentum. The next step is always the hardest step that you take, because we get this inertia. But once you take it, you immediately start building momentum that then gives you more motivation. And then you can leverage that as a springboard to keep getting more results and get them better and faster as well. So stick around to the end. I'll show you exactly how to do that as well. I wanted to start with a bit of an example, though, on the power of time, because I think that a lot of people think when you invest that you need to have a ton of money to get started investing, but that is absolutely not the case. What I've got is an example here showing saving and investing $1,000 every single month and what it does over time. So $1,000 a month, 12 months in the year, $12,000 a year. Over 10 years, you would have put in a total of $120,000. Now, I've looked at the 30-year return on the Australian share market, which is 9.8%. Basically, if you'd invested $1,000 a month over the last 10 years, that you would have the $120,000 that you put in, but you would have got some growth on those shares, on your investments, and you would have got some dividends, which you reinvest, such that you would have about $202,000 in your portfolio. Not bad. You made 80 grand from $1,000 a month. That's a good amount of money. But you see that the power comes when you keep that going, when you keep consistent with that over time. Because after 20 years, you would have put in a total of $240K, but your investments would have grown to be worth $740,000. So you're like 3 times your return. 30 years, you put in a total of $360,000. You got $2.1 million. 40 years, $480,000 in. almost $6 million, $5.95 million in your portfolio, which is obviously an incredible amount of money from just investing $1,000 a month. And I get that, like, obviously we're in the middle of an inflation crisis and sometimes finding that money can seem hard, but you see the results. And honestly, what is the alternative? The alternative is not doing this stuff and not getting the results and just having to sacrifice more in the future. So this shows that you don't need heaps of money to get started, that being consistent is super powerful, and you can create some pretty epic results with a small amount of money just by keeping it consistent. It also shows, though, the power of getting started, because I find that it's really common when people start thinking about their money that they think, oh yeah, I know I need to invest. Yes, I need to do these things, X, Y, Z. But then time goes on, and what happens is that life gets in the way and they don't take action, and then they're chasing their tail. And the biggest benefit you get on any investment is in the last year that you own it. So that means that if you just invest 1 year sooner, you're going to end up in a much better position. I did a piece of content the other day, a little bit off topic, but it's sort of aligned, and this comes to mind, that if you invest $5,000 a year today, by age 60, this is, I think it was for a 20-year-old or a 30-year-old, can't recall exactly, but either 20 or 30, by age 60, that'd be worth $250,000. That means that the cost of not taking action, of not investing $5,000 this year, is $250,000, and that compounds every year that you don't take action. So as I say, power of time, but also the power of getting started. And the getting started part is hard because, as I say, everyone knows that they need to invest, but there's some common challenges that stop you and hold you back. The three biggest ones that I see is this information overload. It's like there's so many options out there. It's so much information. It's like we're drinking from the fire hose, and it's really hard to know who to listen to and who to trust. It's all just overwhelming. The second is that people really struggle to find a good balance between how do you get ahead with money at a rate that you want and live a good lifestyle at the same time. That balance is important to find, but it's not easy to find. And then the third one is FOMO, or the fear of missing out. And it sort of talks to the money psychology that impacts how we invest, how we manage our money. But probably more importantly than the fear of missing out is the fear of making a mistake, that you know that you need to invest, but you don't want to do something dumb that ends up costing you a bunch of money. And what happens is that in the end, you just get paralyzed. You get paralyzed with fear. That leads to inaction and missed opportunities. And ultimately, you sort of end up stuck where you're doing, not necessarily stuck doing nothing, but you're just doing the same stuff that you've been doing in the past. And that means that you're missing the opportunity to be getting better results and getting more out of what you have right now. So what I've found is that investing is really important, but it's only one part of the picture. There's actually three things that you need to get right if you want to be successful with your money. The first is your structure, and that's about making it easy to save, manage your money, and making it clear how much money you've got to work with when it comes to investing or buying property or any other money strategies that you're thinking about doing. The second is your strategy, and that's really understanding what is the ideal pathway to take you from where you are right now to where you want to be with your money, and what exactly do you need to do next to make that happen. And then the third is the investments and the products that you use, the investment solutions that back up your strategy. So you get that reliable, consistent progress over time and avoid the downsides and setbacks and those momentum killing mistakes. Now, if any one of those three elements is missing, it ends up impacting and dragging down everything else. That if you're missing a good structure, you're working with a leaky bucket. If you're missing a good strategy, you're leaving a heap of money on the table. And if you're missing good investments, well, then you blow up your cash and you have to go back to the starting line. So the power of the three together is much more than any one individual element. And as I say, if you're missing any one, it's almost impossible to achieve the results that you want. So as we go through today, I'm going to share with you some frameworks and tactics that you can use to really nail it in each of these areas to make sure that you can actually invest smarter in 2023. So the first one of those elements that I want to talk through is structure, and that's all about your banking and saving. And look, I am just calling out that I fully get that, budgeting, I don't even like the B word, but budgeting, savings, and your spending plan is probably the least sexy part of anyone's money strategy, but it is the most important foundational part that really dictates everything else. And I'll explain to you why, because essentially, if you think about your money, like allocating money that maybe money you've got in a savings account or a bank account, or money that you're getting coming in from your regular salary or income, You've only got two choices. You can allocate it to your spending today and your lifestyle today, or you can allocate it to your spending in the future. Now, your future, when you're allocating money to the future, that's your savings and investments. There's only 6 options that you can use to build your wealth and essentially get ahead. You can save money in cash in a bank account. You can pay down debt. And that's an important one, not a super fun one, but you can pay down debt. It's important to make that manage. You can buy shares, managed funds, or ETFs. I put them in the same bucket. Buy crypto, you can buy property, or you can crank your super and retirement fund is a 6th option. Now, saving money in cash and paying down debt, those two things are really important, but they're never going to like shoot the lights out from a wealth building perspective, because saving money in cash, you get a reasonably low interest rate. Paying down debt, again, you're only saving the interest that you're not paying on that debt. So it is important, but it's never going to, grow in the same way that share investments or property investments or potentially crypto investments or super would grow for you. It's really those 4 options: shares, crypto, property, super, that are the things that will build your wealth over the long term. But those same 4 areas, they're the ones that fluctuate up and down. They have a lot of volatility in the shorter term. Now, getting the results that you want when you invest in each of those 4 areas is relatively simple. I'm not going to say that it's easy, but it is sort of simple. You need to choose good investments, and you need to make sure that you're never forced to sell those good investments at a bad time. Fairly simple. I'll talk about how you can choose good investments, but the key to making sure that you're never forced to sell your good investments at the wrong time, like i.e. at the moment when markets are down and even good companies' values are down, you need to make sure that when you allocate money from the today side of things to the future side, that you're never forced to bring it back the other way. How you do that is you just need to make sure that all of the spending that you want to do on the today side of things is provided for. And look, there's only so many types of things that we spend our money on. You've got your fixed costs, that's your rent, bills, and the boring stuff. Easy to predict, easy to automate, just needs to get paid. You got your spending, that's your walking around money: meals, entertainment, clothes, shoes, etc. That's the one that's going to dictate or drive the most fun for you in the here and now. But it's also the one where we do have a tendency to overspend. And if we spend too much there, then it means that we don't have enough left over for the other buckets. Debt, everyone's least favorite category. Then you got lifestyle. That's your travel fund or new tech toys, things for your house, travel, whatever. Basically, bigger ticket savings to spend. And then you got your savings and investments. Now, the key to having a good budget or a good savings plan is to nail down the perfect allocations between these areas where you're happy with how much you're spending on the today side of things, and that you're happy with how much you're saving to make the progress that you want for the future. Generally, when you're doing a budget, you need to list those things down, look at what's left over. If you're like most people, there probably won't be, when you list out all of the expenses all of the spending that you ideally want to do, you probably won't have as much left over as you would like. So then you need to reprioritize and tweak until you find a balance that you're happy with. And then you've got a great plan. And a great plan is great. Sometimes I get really excited when I'm helping people build plans for their money or for their savings. But then you need to get the results. The rubber hits the road and you need to make it happen. So the key to doing that is, I think, structure around your banking. And this is the way that I personally run my banking. And it's the way that we help our clients run their banking as well, where you get money coming into one bucket and then automatically filtering out into the other bucket so that you got the right money in the right places at the right time. What that does is it means that by having the right money in the right places at the right time, that you can do the spending that you want. It also leverages the power of small barriers, particularly when it comes to your spending allocation, because it turns your spending into guilt-free spending, where you know exactly how much you've got to spend and you can and should spend it guilt-free, knowing that everything else that's going on with your money is looked after. But really, really importantly, when it comes to investing and investing smarter, what this sort of approach gives you is it gives you crystal clear vision on exactly how much money that you've got that you can invest. It also means that you're going to know that all of the spending that you want to do on the today side of things is provided for, such that you're never going to be forced to sell the investments at the wrong time. So, as I said, it is probably the least sexy part of your money strategy, but it really, really is the foundation for everything else and your investments in particular. So it's something really important to get right. I wanted to jump into investments and the solutions that you can use. And I'm going to unpack the three biggest ones, or the three biggest areas that I see. Shares, managed funds, and ETFs as one bucket. Property and crypto. I haven't put super in here as an option because super allows you to invest in all three of those options, essentially just as its own tax structure. And I'm going to talk about tax and how to save tax in the next section as well. So firstly, share investing. Share investing is great because it allows you to start small, particularly with micro investing apps. You can start with a few bucks, some of them as little as like 1 single cent, and get exposure into the share market. The returns on shares are better than the returns on cash over the long term, for sure. 9.8% 30-year return on the Australian share market. I think the long term, the 30-year return on cash is like 4% or something. So you're going to be way better off over the long term by investing in shares as opposed to investing in cash. Share investing is also great in that it gives you total flexibility, because when you do your spending and savings plan, based on that, you might figure out that you've got $100 a week that you can invest, say, and you can invest that $100 a week this week. Then next week, if you get a pay rise or a promotion or a bonus or something, you can invest more. You've got the flexibility to be able to change things. Similarly, if your situation changes next week and you don't have that $100 to invest, you can pause that investment as well. Now, that doesn't mean that you should, because I think that when you're setting your money strategy, you should try and set it up in a way so that you can consistently follow through on the plan that you've set. And you don't want to be having to decide on things and chop and change every week or month, because that's just going to be a hassle and mean that you're less likely to actually follow it through. But knowing that you do have the flexibility there to do that if you need it is something that can be really important and valuable, and give you good peace of mind as well. The other thing with share investing is that investing in shares is good for generating income. And what I mean by that is, particularly if you compare shares versus property, the total return on them is very similar. The long-term return on shares is 9.8%. As I said, the long-term return on property, like growth return plus rental income return, is about 8.6%. So there's less than 1% in it. But with shares, more of the return that you get is made up of your income return, the dividend income that you get, particularly on Australian shares. And what that means is that if you've got $1 million invested into a property, it's going to generate you much less income than having $1 million invested in shares. So particularly if you fast forward to the point where you are using your investments to generate you an income so that you don't have to work, having a share portfolio is going to give you more of an income there. Also, you get solid growth if you're consistent with what you do with shares over time. Now, I wanted to give you a bit of an example showing how much you need to invest if you wanted to grow $1 million share portfolio by age 60. Again, I've used this 30-year return on the Australian share market, 9.8%. What I've found, and I've just done this through a compound interest calculator, essentially, if you're 20 years old today, that you only need to save and invest $6 a day to build $1 million portfolio. If you're 30, you need to save $16 a day. So, $6 a day is something that's like a coffee and a half, depending on where you buy your coffee from. So it should be achievable for most people. If you're 30, then you need $16 a day. That's a little bit more. That's lunch out at somewhere like not the super cheapest place on the street, but not the most expensive either. So again, achievable, but you're doing a little bit more, and it's an extra $10 a day or $70 a week. So it is a bit more money that you need to do. But if you wait until you're 40, then you need to be investing $45 a day, which that's a decent chunk of change. 50, it's $165 a day. And that's getting to the point where you sort of like investing the average income basically to get there. Going to be pretty difficult for most people to actually do that. So the sooner you start, the less you have to do to end up in the same position. And the later you start, the more you have to push, the more you're going to have to sacrifice if you want to get to that outcome, or you're going to have to sacrifice on the outcome that you get to, where you get to overall. So when you invest in shares, and you can see from that share investing is powerful, but you want to choose between the different types of options. This is where a lot of people get stuck. You can essentially invest in shares directly, where you buy a share in one particular company. That can be great in that it gives you exposure to one company and means that the total return that you get is just the return on that company. So if that company does really well, then your portfolio does really well. On the flip side, though, if that company does poorly, then your investments do poorly. And I think for me, that's the big downside of direct share investing, is that you would say that you've got a lack of diversification, because you're invested in a small number of individual companies, one or a small number essentially. With a managed fund, how that works is that you buy one managed fund, but that managed fund in turn invests in a whole bunch of shares underneath it. That's very similar to an ETF, where you buy one ETF which invests in a number of underlying shares. And the managed funds and ETFs are very similar, except for the fact that ETFs are bought and sold on the stock exchange directly. Managed funds, you need to have an account with a managed fund provider, or do it through a micro investing app, which I'll come to in a sec. But then essentially they run the investments for you. There's generally a minimum on setting those up, and minimum contributions and stuff as well. There are slight nuances in the tax treatment between managed funds and ETFs. It gets pretty complex pretty quickly, but essentially with an ETF, you own a small slice of the shares, which gives you a little bit more control over the tax outcome. Whereas with a managed fund, you're in a big pool with investors, and all of the tax outcomes are shared between anybody that's in the pool. Then you got micro investing apps. Micro investing apps sort of exploded onto the scene in the last decade, but with good reason, that they generally allow you to invest in either shares, managed funds, or ETFs, or generally, more than one option, sometimes all three. And they typically have a pretty slick user experience, nice and easy to use and set up. Most of the time you can do it on your phone with a few flicks of the thumb, and allow you to get started investing that way. Now, one thing that I've found for people when they want to invest, particularly in the early days, that they get paralyzed by choosing between these options, because they've all got advantages and disadvantages, and that it can be a real barrier. What I would say with this is that if you have less than $200,000 in your investment portfolio, the actual differences that you get in terms of the dollar returns over time are going to be pretty small. Yes, there are slight differences in the tax outcomes, and yes, there might be slight differences in the fees, but you will hardly notice it unless you have more than $200,000. Even then, you might notice it a little bit, but the dollars will still be relatively small. So what that says to me is that instead of paralyzing yourself and spending all of this time focusing on, do I use an ETF, or do I use a managed fund, or do I use a micro investing app, then what you should instead be doing is focusing on a solution that's easy for you to use, easy for you to set up, easy for you to automate regular investments into. Because investing more and investing consistently and investing regularly is going to grow your investments much faster than this 0.001% extra uplift that you get from the tax benefit, or having the very best optimal investment option. I hope that makes sense. I generally suggest, particularly because micro investing is probably the cheapest and easiest way to get started, that if you don't know where to start, that's probably a good thing to look at as a starting point. Then as your portfolio grows and you learn more about investing in the options, you can investigate further and see if there is something better over time. But in a lot of cases, and we've got a lot of clients that, and I personally continue to use a lot of these micro investing platforms, because they are just so easy to use, which means that you invest more, which means that you get better results. So that's shares. Talking about property investing, property and shares, as I mentioned before, that the return is broadly similar. Property, it says that the overall return is slightly lower than shares at around 8.6% when you factor in rental income, compared to 9.8% on shares. But property does tend to win over shares because of the power of gearing. Now, gearing just means borrowing money to invest. So anytime you borrow money and invest, that's referred to as gearing in financially jargon. And essentially with a property, because no one really, or not many people at least, go out and save up $500,000 and buy a $500,000 property. Instead, what you do is you save up your property deposit, and then you go and borrow a bunch of money from the bank, and then you invest the money that you've saved and the money that the bank has lent you to go and buy your property. That means that you gear up. That's where that name comes from, that you gear up and you end up with a much bigger asset that's working and growing for you, as opposed to just investing in a share portfolio. And even if you choose a great share portfolio, investing, if your options are, do I invest $100,000 into a share portfolio, or do I invest $100,000, borrow money from the bank and buy a $500,000 or $1 million property, the share portfolio is never going to be able to keep up in a property that's 5 or 10 times the size. But when it comes to property, there is a cash flow impact, because it doesn't have the flexibility that you have with shares, that you can choose to invest 1 month and not invest the following month, or invest more the month after and less the month after that. With a property, you have to pay your mortgage month on month on month. That means that you need to really carefully manage the cash flow of that purchase and manage your risk in doing that. So when you're planning your property purchase, you need to understand not only how the property is going to fit for you today, but how it will fit for your situation a month from now, 6 months from now, 3 years from now. And I think we have just gone through the fastest rate of interest rate tightening since 1994. And it's caught a lot of people out in that they probably hadn't anticipated rates rising as quickly. And I think that's something that's always really important. Now people are making difficult decisions going, well, I have to pay these interest rates. What am I going to sacrifice on? And it can be difficult decisions. So you want to plan for the worst, hope for the best, but make sure that you've got a plan so that you can comfortably purchase that property. Got a question here that says, does margin lending equate to gearing up in the share market? Yes, it does. Absolutely. Margin lending is where you borrow money and invest into shares. It's a bit of a funny structure with margin lending, though, where how it works is that normally a margin loan is secured against your share portfolio. And in order for you to borrow or hold the margin loan, you're required to have a certain amount of equity. So the banks might approve you to, say, borrow at a gearing rate of 50%. That means that if you've got $100,000 in a share portfolio, the banks will be comfortable for you to borrow $50,000, say, at 50%. So then what you can do is you get the $50,000, you go and invest into shares. You've got a $150,000 share portfolio, which is 50% bigger than you otherwise would. But where you can run into trouble with that is that if the share market goes down, sort of like what we're seeing at the moment, say the share market goes down by 10%, you've got $150,000 in there. So your total portfolio value goes down by $15,000. The banks, because the banks only want you to be geared at 50%, then they can force you to sell your shares to bring your portfolio or bring your borrowing levels back down into the range that they've approved you for. That is an issue because they're potentially going to be forcing you to sell investments when the markets are down, which means that you're crystallizing a loss. And that ends up being a real hassle. Now, I'm not against borrowing to invest into shares, but I much prefer to do it in a product like borrowing against your property equity, where you can borrow at much lower interest rates and there are no margin calls, or using a product like, this is not financial advice, but NAB have a product out there where you can borrow and then there's a fixed term. You can invest into shares. Again, there are no margin calls. So that sort of setup, the interest rate on that product is about 8 or 9% at the moment, which is really quite high. And I think it's really prohibitive. Yeah, it can be a better way to invest in that. At least you're not having the margin calls that are associated with margin loans. I hope that one helps. So I wanted to show you property and property growth and why it's so powerful. And I've got an example here showing like what if you had a $1 million invested into a property investment, how it would grow over 1 year, 5 years. And I'm going to extrapolate that out. I've done this for $1 million, $2 million, and $3 million worth of property, just so that you can see. And I'll sort of unpack the numbers, but I'll then give you my thoughts on what it actually means. Now, the long term, the 150-year growth rate on Australian residential property is 6.3%. So basically, if you bought a $1 million property and assuming that 6.3% annual growth rate, that in a year's time, it should be worth about $1,063,000. Now, we know that property doesn't go up in a straight line. The current property market is showing us that. But over the long term, you'd expect the outcomes. I expect the outcomes to be quite similar to this over time. Then after 5 years, you can see that $1 million property has grown to $1.35 million. So you basically put on $357,000 in 5 years. And while I had that example about share investing at the start, super powerful, you can see that the property is much more powerful because you're not starting with $1,000 a month. You're starting with a $1 million asset that's working for you. Then you got 10 years, $1.84 million, or you can see on the bigger property numbers, the numbers are even bigger. 15 years, $2.5 million, 20 years, $3.4 million almost, 30 years, 6.2, 40 years, 11 million, big one. So 8 figures in wealth. This is literally using the 150-year return on the property market team. So again, it's reasonably, the past doesn't predict the future necessarily, but I would expect that for good properties, and I'll talk about how you choose them in a sec, but for good properties, you'd expect it to be the same. Now, what this says to me is that property can seriously accelerate how quickly you build your assets. But what it also says to me is that you don't need 10 properties to get rich. You probably don't need 5. But some is better than none and will definitely help, because if you look at your profit here, at any point you take away the $1 million or the $2 million or the $3 million you got started with, you can see that there's a serious amount of profit there to be made. So again, powerful time of making it happen. I think share investing is great and a great place to get started, but property is really the accelerator on your journey to building serious wealth. That's why it's important that you have a plan around that. Make sure that plan is smart and that you set yourself up for property success. And my take on that, and there's a lot of different ways to be right when it comes to property. It wouldn't take much Googling around to see the different, like the diversity of opinions around this. People talk about buy, renovate, flip, buy in the regional hotspots, buy in the unloved suburbs, or whatever. There's tons of different ways, and all of them can be right. A lot of them have been right in the past, and some of them are going to be right again in the future. But my take on how to be successful as a property investor is to buy premium properties and hold them for the long term. What you do with that is that you take a lot of the noise out of it. It's very different to a strategy where you're going to buy, renovate, and flip, whereby you have to go find a property. You spend a lot more time doing your due diligence because you've got to find a property that's going to meet the criteria that you want for doing it up. Then you got to buy it and do it up, which is a lot more work, comes with a lot more risk. And then you got depending on what's going on in the property market at that time, you sort of always questioning, well, is now the right time to buy? Is now the right time to sell? Is now the right time to do these renos? Very different to finding a premium property that you're comfortable to hold for the long term and then holding it for the long term. Because when you're looking to do that, you just say, well, when does property make sense with my strategy? How do I manage that lifestyle risk? And then you just make it happen, knowing that the market noise is simply that, just the noise. So when you do that, you have to plan smart, and managing your lifestyle risk is really crucial. But property, important and a powerful one. Crypto investing, look, I wanted to include this for completeness. Obviously, there's a lot of disruption going on in the crypto market at the moment. We have seen over the last little bit a lot of growth. That sparked a lot of interest, although it's funny how the crypto bros have gone a little quiet in the last 12 months since the market started falling off a cliff. But I think it's important to understand crypto because it is an asset class that that can't really be ignored. I think at the moment, you want to, when it comes to money with a lot of things, and crypto is one of these things, that sometimes you want to explore something, even if you're just going to rule it out. Like, you look at crypto, is it right for me? Then you decide no, and then you've made a decision that crypto is not for you. That is different to thinking about crypto, not exploring it, and then deciding not to do it, because then it's just that you haven't explored it properly. That being said, I think that there is some opportunity in crypto. We're seeing the huge expansion of crypto adoption by bigger players. And just let me know if that's coming through. I'm back. Yep, great. Okay, sorry about that, team. This is the joys of living in the age of NBN internet, but here we are. So I'll just make sure this is coming through. Perfect. So crypto, huge future expansion probability. But I think one of the important things when you invest in crypto, you should know that you don't need crypto to invest. I think that there's opportunity. I own a little bit of Bitcoin myself as a small sort of higher risk speculative investment. If it turns to zero, for me, I'm going to be disappointed. Of course, I never want to see an investment turn to zero, but it's not going to impact my long-term wealth plans. And I think that that's the approach that you need to take, because when you look at some of the examples that I've shared with you guys today already, you look at 9.8% return on the share market. You invest $1,000 per month and it turns into $6 million over time. You don't need more than that 9.8% to achieve serious results. So you got to think about how much risk do you need. And if you choose to invest in crypto, like if you choose to invest into startup investments or any other more speculative type investments, you want to do that knowing that you've got the foundations of your investment in place so that your portfolio is rock solid, and it's not going to be an issue if it takes a long time for those investments to pay off, or if they don't pay off at all. So I want to talk about tax, because tax is important on a societal level, but I think in my take, you don't want to pay any more tax than you need to. And when you think about investing, the tax is the biggest roadblock and the biggest potential opportunity. And when you invest, the after-tax return is the only return that matters. The only return that matters, because it's common that people get caught up on headline returns and wanting to maximize that. But really, how much you have after you pay your annual donation to the ATO is really the important thing here. I've just got a couple of questions here, which I think came through when I was having that bit of a tech glitch. So I might just touch on those before I press on with the tax piece. Got a question here that says, in ETFs, do you think there is a correct balance between investing in Australia versus international shares, and why? Struggling to begin investing in ETFs because of not knowing, being overwhelmed with what to choose and how much my portfolio should be allocated to what. Yeah, that's a really good question. I would say that Australian shares are great, but Australia is a very small part of the global economy, and our share market is very small relative to the rest of the global share market. So it's good to be outside of Australia. However, because you can't buy your latte with pesos, then you want to be invested into shares that are denominated in Australian dollars. That's why Australian dollars are important. Also, Australian shares and the returns on them are going to be more linked to what's going on in the economy. Where inflation is high in Australia, it means that returns are higher to compensate. These sorts of things, that it all sort of balances out. I would say, though, that it's probably probably, and there's a whole bunch of different ways to do this, but somewhere around half is probably a good starting point for a lot of people when it comes to how much you should have in Australian shares versus how much you have in international shares. It does, one of the drivers there is if you're investing in international shares, if you're investing in currency hedged options, then that can make a difference. Not to, you mentioned you're overwhelmed, so I don't want to overwhelm you anymore. But I think that should, for me, that's probably a reasonable starting point, knowing that you've got that balance there as well. So I hope that helps. Another question. It says, as Pella doesn't offer crypto and there's a lot of drama around FTX, if you were to invest in crypto, what platforms would you suggest? Oh, look, I have to say I'm not a crypto expert, but I would say that choosing a platform, as you've seen with and referred to in your question with FTX, that the platform that you choose is all important. It's really hard from the outside to see because with FTX in particular, that was like, the golden child of the crypto space, that you wouldn't have thought that what has happened there would happen. And what that suggests to me is that a lot of these platforms, they don't, like, they've got a lot of risk there, and risk that's not always clear with them. It's very different to a platform like Perla or an investment platform where they are protected under APRA. So fully protected. Platforms like Perla or Comsec or eTrade or any other micro investing app, like, they do not hold your money. They act to receive your money and then pass it on to a custodian, such that if any one of those companies would go bankrupt, which even is quite unlikely given the level of APRA protections in place and audit provisions and all of that sort of regulatory oversight, that your money is safe, in that you just need to find another administrator for your money, because your money is not tied to them. Different to a crypto exchange like FTX, where it's like that money is gone and then your money is gone. And so I think you need to tread really carefully with how you do that. There are some crypto ETFs coming onto the market, and I'm expecting more innovation around these in the future. Those sorts of products have a real advantage in that they actually have custodian arrangements. So there are things called crypto custodians that hold on to the crypto and actually keep it safe. So I would look into that, maybe look into crypto custody and ETFs to see what you can find. But I'm also hopeful that we actually get, I'm not a big fan of, massive over-regulation, but I hope that we get more regulation in this space so that we get more protection for investors, so that we've got more confident options. So I know that probably doesn't give you anything definitive, but I hope that makes sense. Another question here from Turnip. G'day, Turnip. It says, 30 years old and beginning my investment journey. Given that we seem to be in a downturn and potentially looking at a recession, how important do you think it is at the moment to hold gold in your portfolio, or is it not the time to be, or is not the time to be purchasing cheap exposure to the market? I'm not 100% following that last bit, but I'm not a big fan of gold. It's probably partly a preference thing, but I think it does have uses, but it is a weird sort of like commodity thing. So for me, I don't think it's that important, but am I a super guru investment person? Maybe not so much. You probably get different answers if you ask some, multi-billion-dollar portfolio manager potentially. But I think keep it simple, and particularly if you're just getting started investing, you don't want to make it too complicated either. It's probably not going to make that much of a difference if you've got a relatively small portfolio. If you have a small allocation of a small portfolio to something like gold, probably not going to matter. If you get to the point, when you get to the point that you've got $1 million investment portfolio, you probably want to be looking at those things more closely. But again, even for that, like, we advise clients with $1 million portfolios, and we don't advocate them putting gold into them. So again, a bit of a philosophy type thing, but that's our take on it. So I hope that helps. Turn it. So going back to tax, and Selena, I've seen your question here. I might just hammer through this tax stuff, and then you can let me know if you've got a follow up on that one as well. So you've only get one tax rate, and tax rates are different for different entities. And What I mean by that is, and I'm sorry for jumping around, but essentially, if you have an investment account in your personal name, you own the shares personally, and all of the income from those investments gets added onto your personal assessable income, and then you pay tax at your marginal tax rate. You can also choose to invest in your partner's name, and then the income adds to their taxable income and is taxed at their marginal tax rate. You can also invest through a super fund. A super fund has a maximum tax rate of 15%, which is much lower than a lot of marginal tax rates. So it actually has a huge advantage there. That being said, your super money is trapped, until you're old. So it's probably not going to be your first strategy that you go to, but it also probably shouldn't be your last. Then you can invest through a proprietary limited company. Like anyone can open an investment company, and investment companies have a flat rate of tax that applies to them at 30%. So that can be, helpful as well. Or you can invest through a trust, and the rule with a trust is that it needs to distribute to other entities, and that again gives you some tax planning options. I'm going to talk through a bit more about that in a sec. Looking at the marginal tax rates, though, just as a refresher, essentially in Australia, we work under this marginal tax rate system where the more income you earn, the higher rate of tax that you pay. Basically, the first $18,000 that everyone earns in Australia pays 0% tax. Then when your income gets above that, on any amount earned between 18,000 and 45,000, you pay 19 cents in the dollar. You still get the first 18,000 tax-free, though. Then if you go into the next bracket, 45 to 120,000, you're paying tax at 34.5%, 120 to 180 is 39%, and 180 plus is 47%. What that says is that if your assessable income is above $45,000, which most people's, that's way below average salary in Australia, that you're paying 34.5% of your income and any investment income that adds on top of your salary income out in tax. If your income is higher, then your tax rate is higher as well. So you're losing a third of your investment income in tax essentially by owning stuff in your personal name. So being smart with your tax is more important, and the higher your income is, the more important that is. I wanted to show you an example here talking about earning $10,000 of investment income, but earning that income under different entities across a family group. I've just got a family group, family of four, and the different entities available to them to give you an insight as to what tax entity planning looks like. Sorry for throwing jargon at you, but essentially a tax entity is basically anything with a tax file number. So every individual is a tax entity. They all have their own tax file number. Every super fund is its own tax entity that has a tax file number, companies, trusts, etc. as well. So getting into the detail, I've got this family here. First cab off the rank, mum earns $125,000. Her tax rate is 39%. If mum was to earn $10,000 of investment income in her name, she's going to pay tax of $3,900. Then we got dad. He's on $35,000. His tax rate is 19%. So dad would pay tax of $1,900 on the $10,000 of investment income. We've got a 15-year-old daughter earning some money from doing a shift at Macca's on the weekend, $5,000. Because she's a minor, investment income is taxed at 47%, so the tax would be $4,700. Then we've got an 18-year-old daughter doing the same shifts at Macca's, earning $5,000. Tax rate zero, so tax paid on $10,000 of investment income would be zero. Super fund, income doesn't matter. Tax rate is maximum rate of 15%, $1,500 in tax on $10,000 of income. Then you got proprietary limited, so an investment company, they would pay $3,000 of the 30% company tax rate. And a trust, well, it depends on where that income is distributed to. Now, I wanted to show this example because tax strategies are one thing, but being strategic with where you own your investments and where you earn your investment income makes a big difference to the after-tax return that you get and how much money you can then reinvest to grow your wealth faster. You can see from this example that the difference between paying the least amount of tax across this family group and paying the most amount of tax is $4,700 out of $10,000. So basically 50% variance here. Now, that's a lot, and that's $4,700 that you can use to grow your wealth faster. That $4,700 is an annual number, annual. And if your aim is to replace your income investing, then, which is one of my key definitions of financial freedom and security, then you are going to have to build a significant income from investments in the tens of thousands of dollars. You're probably doing that by earning a decent salary that allows you to save that much money, which means that you're going to be in a higher marginal tax bracket, which means that you should be really strategic with where you own your investments so that you can boost your after-tax return, so you can keep more of that money to grow your wealth faster. I appreciate that there's a lot of detail there, but I wanted to, and we've only really just scratched the surface, but I wanted to show you the power of what's possible with being strategic on where you own your investments, because I think that's a huge opportunity. Investing, as I see it, is one of the biggest areas to save tax. And I'm actually doing a full deep dive on tax planning in one of our upcoming events, so you can get around that as well. But particularly for individuals that are not business owners, investing is the biggest area that allows you to save tax. I'm gonna jump into some of the mistakes for you to look out for and avoid. Now, the first one is that thinking that choosing good investments is all that matters. Choosing good investments is important, but it's only a small part of your money success. What you need to do is, yes, you need to choose good investments, but you need to invest the right amount at the right time. You need to be smart with your tax and tax planning from the stuff that we've just gone through. You need to have a good risk management strategy, all of these things. And I think that people think that they put so much into, choosing this ideal investment, but just choosing great investments is not going to get you rich. You need to do all of those things. So you make sure that you're clear on your strategy, and I'll talk a little bit about how you plan. You also don't need to be an expert today, right now. If you think about being super successful with your money, you're going to need to know a lot. You will know a lot, but you don't need to know that. You just need to know enough to take the next step today. You need to be clear on what you're going to do next and what is the knowledge that you need to have the confidence to take that step. That's all that's important. Then you take that step, you learn some stuff, you build some knowledge, you learn more, you do more, and you get better results. And then you build that knowledge over time. Not looking ahead is another big one where, not being clear on the impact of you saving how much you're saving today or investing how much you're saving today. You've got to look ahead so that you know if you need to change anything and how much you need to change it. Not building habits is a really big one too, that, as I mentioned in the first slide, with the well done to you guys, that habit building is all important here. Good money habits, good money behaviors is a massive, massive driver of the results that you get over time. So you've got to create those structure, systems, processes with how you do things, how you check in on your money, how you invest your money, how you keep your motivation building to get things happening. And waiting for the right time is another thing as well. There's always a reason to delay taking action with your money. Always. It could be, oh, Christmas is coming up. I'll just do that in the new year or after that thing or after I get that pay rise. There's never a right time. You just got to get started, and then you build motivation to keep things going. And as I say, put those structures in place to keep it consistent over time. Also, trying to figure it all out on your own is hard as well. It means that you've got to learn by trial and error. That means you're making mistakes that are going to cost you money and cost you time. It's hard to not fall victim to your psychology and decision making, and mean that you're not taking advantage of the opportunities that you can to get ahead, and ultimately it's slower progress. So guys, I hope you found that helpful. I'm going to come to questions in a sec. So anyone with any questions, you can fire them through. I just got two things that I want to leave you with. The first is how you can actually plan with your money, plan with your investments, and plan to invest smarter in the new year. First thing you need to do is focus in on what's important. Where do you want to be? What do you want to not be? What are the guidelines, like the outcomes that you're working towards? From there, you want to understand all of the different moving parts that are going to impact your plan. What money's coming in, what money's going out, where's it going, how do you manage things? Basically building your baseline, both today and looking ahead at the things that will change over the short term, so that you can see how much money you've got available to invest. Then you can look at, well, what if I buy shares? What if I buy property? What if I pay down debt? What if I crank my super? What if I do a combination? And then choose the best strategy that gives you the financial results that you want, while also allowing you to live the lifestyle that you want. Then you break it down into an action plan and try and automate as much as you can, so you get out of the way and let your strategy do its thing. But that's what turns into the results, the dollars in your bank account, as well. 1 through to 5 on this map is having your plan set up and the track to run on. And then 6 is ongoing, where you need to make sure that as things change, what you want, what's going on in the world, what's going on in your money, that your plan still makes the most sense for that. I'm going to give you this simple model to leave you with, talking about getting from where you are to where you want to be with your money. Now, essentially how it works is that in the future, every single one of you guys is going to be in one of 4 positions, essentially ranging from really really bad to really good. When people think of getting from where they are to future state with their money, they think about it like a straight line. But because of the compounding impact of time and money, it's actually a curve. So if you're not 100% on track to end up exactly where you want to be with your money, then you need to do some stuff. You need to jump the line, and you need to start that savings account. You need to start that investment account. You need to buy that property or whatever. From there, you just need to stay on the line and take the next step and the next step and the next step, which is easier because you are already on the path. But the longer you leave it, the more time that goes on, you need to sacrifice more to jump the line. And, getting here can be painful. Putting yourself in the best position can become impossible because the sacrifices that you need to make are just too much. So the sooner you get started, you see that the gap between the line is smallest, the less you need to do. And then you're on track to end up in a better position. So this is my motivational pep talk to say, it's all possible. It's all possible depending on which levers you want to pull or what's most important to you. But the sooner you start, the less you'll have to do to end up in the same spot. So guys, I hope you found that helpful. Guys, this is what we do for people as well. So I've actually just popped a link into the chat. We do these 10-minute phone calls. If you want to hear more about that, basically talk through where things are at for you, give you a bit of no BS Q&A and understand your next steps. If we think we can help, we can talk about how. If we can't, we can point you in the right direction. So I've just popped that link into the chat. You can feel free to get around that. Also, as mentioned, and thanks for all the questions and stuff coming through. I had a couple of suggestions on future topic ideas, but check out our upcoming events happening over the next couple of months and the content streams there as well. We'll send an email out with those links as well as a recording so you can listen back to any of my jokes and look at the slides and stuff as well. But guys, I hope you found that helpful. As I said, I hope you got a bunch of great ideas, but now it's over to you you got to take action if you want to get results. And that's where the money will come from for you. So get into it. I am just going to look at these questions here. Jamie says, Jamie, I hope I'm saying that right. Jamie, not sure. Anyway, is there a percentage of income that generally should be allocated to investing, saving? My view on that is no. I do get asked that a lot by journalists to say, what is the right percentage? But the reality is that any percentage can be right or wrong. Sometimes 50% is too much. Sometimes it's not enough, depending on what your income is. The right savings number for you, though, for every single one of you guys here is to say, you look at how much you're saving, look at what it means for how quickly your assets will grow. And if you're happy with those outcomes, then that means you're saving the right amount. If you're not, then you need to save more and invest more. That's the power of looking ahead and doing that. Appreciate all the love on the chat, guys, coming through. You're very welcome. It's great to have you here. Tell all of your friends, please. Great, guys. All right. Well, I'm mindful of time. I can see there are a few questions there. So if anybody has any burning questions that are unanswered, drop us a note through the Pivot Wealth website. Great to have you guys here, and I will catch you on the next one. Bye for now.